Hey MCE crew, I hope your day is progressing profitably. You know I always tell you, do your due diligence before investing in anything. Do not just trust some person inside of a screen to tell you what's good for you. There's so many different investments, so many different nuances to everything you can put your money in. And guess what? The variables that pertain to you may not pertain to me. Old Cramer. Now Cramer, he's entertaining. But you know what? Cramer has been wrong a lot. Case in point.
However, that doesn't mean you should give up on every single Chinese IPO. While a lot of them are indeed low quality, there's a big caveat. The larger ones, they tend to be much, much better than the smaller ones. Doesn't make them a sure thing, but it means they're sometimes worth buying on a case-by-case basis, which brings me to the one I want you in on. DiDi, D-I-D-I. That's the Chinese version of Uber that's coming public on Wednesday. This company has a stranglehold on China. The ride-sharing market, they own it. They crushed their competitors and then bought them up when they got tired of losing money. That includes Uber China. DiDi's also got some really huge backers. Chinese tech giants like Alibaba and Tencent, a Japanese conglomerate like SoftBank, even Apple is in DiDi. Finally, based on the proposed price range, which values DiDi at around $65 billion, I think the valuation seems eminently reasonable. Now, there are some antitrust concerns here, but as long as they stay on the Communist Party's good side, and I know it's probably hard to do, but as long as they do, I doubt they'll have much trouble with the regulators. So if you want to speculate on a Chinese IPO, you've got my blessing to bet on DiDi. I would try to get as many shares as you can. DI.
Firms in China continue news. This time it's DiDi Chuxing, which is China's biggest ride-hailing firm. DiDi Global has said that removal of its app from smartphone app stores may adversely impact its revenue in China. This after China's largest ride-hailing firm was banned by country's cyberspace regulator.
Okay, so today we're going to talk about DiDi, the ride-sharing company out of China, right? This is the other part of what we're going to discuss. Now, we had a little fun with Cramer, at his expense, but it is illustrative of the fact that you need to do your due diligence, okay, before investing in anything. Let's go through this DiDi situation and figure out what's going on. Now, the Chinese have suspended that ride-sharing app. So basically, they have put them out of business, maybe temporarily, I don't know, maybe permanently, we shall see. But in addition, once they suspended the app, it definitely affected the shares. So let's go through, figure out what's going on, and look at the ways in which you have to be very careful when investing in companies that are based outside the U.S., right? Okay, here goes. Chinese regulators suggested DiDi delay its U.S. IPO. I'm reading from the Wall Street Journal. I'm going to link to it. Weeks before DiDi Global went public in the U.S., China's cybersecurity watchdog suggested the Chinese ride-hailing giant delay its initial public offering and urged it to conduct a thorough self-examination of its network security, according to people with knowledge of the matter. But for DiDi, waiting would have been problematic. In the absence of an outright order from the Chinese government, the IPO went ahead. The company, facing investor pressure to list after raising billions of dollars from prominent venture capitalists, wrapped up its pre-offering roadshow in a matter of days in June, much shorter than typical investor pitches made by Chinese firms. So let's take a look at that. Prominent venture capitalists. Okay, these are the high-powered folk with a lot of money, and they put forth a lot of money into this company. And you're about to see they're losing a lot of that money in short order. It didn't even take an inordinate amount of time for this to happen. Okay, so the listing on the New York Stock Exchange raised about $4.4 billion, making it the biggest stock sale in a Chinese company since the Alibaba IPO in 2014. Back in Beijing, officials, especially those at the Cyberspace Administration of China, remained wary of the ride-hailing company's troves of data potentially falling into foreign hands as a result of greater public disclosure associated with the U.S. listing, the people said. And see, that's one thing about investing in America. There's a whole lot of transparency that comes along with that. And that's good for you because you've got to know what's going on with these companies before you put that's a part of your due diligence. So the United States is saying, hey, we have some transparency requirements. China's saying, hold on. Now, your transparency requirements might actually run afoul of our security requirements. Remember, China is an authoritarian state. It's a high security state. And unfortunately, the United States in many ways is going down that road. But for now, China and the United States don't agree on this issue. DiDi's American depository shares began trading in New York on last Wednesday, just a day before the ruling Communist Party celebrated its centenary. Now remember, we went over this in a previous video, but the American depository receipt is basically the way that a foreign company can be invested in, bought and sold here in America. The Cyberspace Administration in China waited a day after the major political event to deliver a 1-2 punch to the company. On Friday, it started its own cybersecurity review into DiDi and blocked the company's app from accepting new users. And on Sunday, it ordered mobile app stores to pull DiDi from circulation, effectively, ending their business model. The sudden regulatory actions, which surprised investors, I bet, in coming just days after the company's IPO, suggested that protecting national security trumps Beijing's ambitions for China Inc. to go global. One upshot, Beijing is unlikely to hold fire even if its regulatory moves risk the ability of Chinese firms to court international investors. Now, as someone who's watching this channel, you are a part of the MCE crew. I will take it that you are someone who's interested in growing their money through investing in equities and other assets. So you see what's going on here in China? Doesn't this give you pause from the standpoint of putting your money up into a Chinese company potentially? According to people familiar with the discussions, the company received mixed signals from different agencies within the Chinese government. Some financial regulators have publicly expressed support for the company's overseas listing, while also stressing the imperative of protecting sensitive data and networks. It isn't known whether DiDi carried out its own review. The company ultimately decided to go ahead with the IPO as it faced increasing investor pressure for a big payout, according to a person close to the company. Now, you might remember a few months ago, China cracked down on Jack Ma, the CEO and founder of Alibaba, and really took him out of the public square. Now, I haven't heard from Jack Ma. I think he's still alive, but you haven't heard him say much since China, the government of China, the CCP, the Chinese Communist Party, made that move. So it's vastly different in terms of the control that the government of China has over the CEOs there and the businesses there. And you've got to consider that when you are investing outside the shores of America. The Cyberspace Administration didn't respond to written requests. DiDi said in response to questions that it doesn't comment on speculation and had no knowledge prior to the IPO of the regulators' decisions to put the company under cybersecurity review and to ban new downloads of its ride-sharing app. Now, the reason they're saying that, and you're going to hear more of that, is because DiDi is probably going to get sued now in an international court. I don't know how well that's going to work out for investors, but there are going to be allegations that are made that suggest that you guys knew that the government of China was looking at you in an unfavorable manner and might take this move to shut down the company's app. So you can expect some lawsuits to start flying. But here's the thing. Lawsuits take a long, long time to fight. So getting any money back, who knows? Who knows if that'll ever happen? At the heart of Beijing's concern is data sovereignty. Since late last year, President Xi Jinping has stepped up control of the technology sector and its vast stores of digital data a key area of regulation. Now, a lot of people in America might say, you know what, yeah, Xi Jinping, stick it to those tech companies because over here we got Facebook and Google and Apple, and they are just running roughshod, and in many ways they are. A lot of people in America are calling for government control, more government control of these companies. But Let's continue, and then you can decide whether or not that's really something you want to see. He, Xi Jinping, personally intervened to block the planned blockbuster listing of Alibaba's giant financial technology affiliate, Ant Group Co., just days before its scheduled debut in November. Again, that heavy-handed Chinese government saying, no, you're not doing your IPO. Soon afterward, various market and financial regulators kicked off a campaign to rein in the nation's tech giants, including Alibaba, conglomerate Tencent Holdings, and online search firm Baidu Inc. The effort shows that these tech giants, with their troves of data, deep coffers, and reach across all aspects of Chinese life, have become a national security concern for China's leaders. In May, China's legislature passed a data security law that will give the state more power to get private sector, pay attention to this. In May, China's legislature passed a data security law that will give the state more power to get private sector firms to share data with authorities, but to restrict them from sending information overseas. The law takes effect on September 1st. So this is, again, the Chinese government saying, you know what, you guys are collecting all this information, and we, the government, reserve the right to use it in our security apparatus, in our vast security apparatus. Looming behind the security fear is rising geopolitical competition between the U.S. and China. American lawmakers have demanded tougher audit requirements that they say are necessary to boost transparency into U.S.-listed Chinese companies. Calls that only grew after China's Luckin Coffee Inc. said last year that a chunk of its sales had been faked, sending its NASDAQ-traded shares down 75% in a matter of days. The Public Company Accounting Oversight Board has identified more than 200 U.S.-listed foreign companies, most of them based in China, whose audit work the U.S. body cannot expect. So if they can't inspect it, if you can't get transparency, if you can't find out what's going on with the financials in the company that you're thinking about investing in, you shouldn't invest there. Okay. All right, guys. So that's what's going on with DiDi. It is a great illustrative example of how you really need to be careful when you are investing in foreign companies, especially IPOs. The other thing we covered at the end, old Cramer. Old Cramer. Man, sometimes you just look at Cramer and say, you know what? Tell me what you're going to do, Cramer. I'll do the opposite, and then I'll make some money. But hey, look, again, Cramer will probably be the first to tell you, look, do your due diligence. Okay, guys, as always, it's been fun. I'll talk to you soon.